Today, we're going to unpack what many consider the holy grail of investing. This is a statistically solid strategy that's really designed to shift your entire perspective. We're going to move away from treating the market like a casino and start acting like what you actually are when you buy a stock, a part owner of a business.
So, here's how we're going to break it down. We'll start with that crucial mindset shift. Then we'll walk through the three core pillars of the system: intrinsic value, institutional conviction, and high growth potential. And we'll wrap it all up with the ultimate safety net that protects your capital and really locks the whole thing in place.
You know, the fundamental problem for most people trying to invest is their entire approach. They have a gambler's mentality. They're chasing hype. They're reacting emotionally. The real key to long-term success is a deep shift in that mindset. A stock isn't a lottery ticket, right? It's fractional ownership in a real, living, breathing business.
And this slide really gets to the heart of it. On one side, you've got the casino mindset. You're just chasing ticker symbols, you're driven by fear and greed. But on the other side, you have the disciplined business owner. This person analyzes the underlying value of the business. They know they're buying a piece of a company, not just some blip on a screen. And that's where patience replaces panic.
All right, so our first pillar is the absolute bedrock of this entire system: finding a company's intrinsic value. Just think about it for a second. You would never, ever buy a house without getting it appraised first, would you? Well, proper valuation in the stock market is that exact same non-negotiable step. Without it, you are flying completely blind.
So what is intrinsic value really? Well, it's the real, calculated worth of a business based on its assets, its earnings, and its competitive advantages. And it is completely separate from the wild, day-to-day emotional swings of its stock price. Our job is to find the gap between those two things and then exploit it. Now, we don't just guess at that value. We use a three-pronged approach, and the first point of that triangle is Morningstar. They're considered the gold standard for their really conservative analysis. They focus on something they call economic moats. These are durable, long-term competitive advantages, like a powerful brand or unique tech that protects a company from its competition.
Okay, next, we need a numbers-based reality check. A tool like InvestingPro can give us this by running a company's financials through like 15 different mathematical valuation models. This isn't about opinion or a story, it's about hard data. And let me tell you, when the qualitative story from Morningstar lines up with the cold, hard math, that's when you know you're onto something special.
And here's what that opportunity looks like. Let's just use Alphabet, Google, as an example. The market might panic over some short-term headline and push the price down to, say, $130. But if our analysis shows that the actual fair value is closer to $160, that $30 gap, that is our opportunity. That's our potential profit, sitting right there on the table.
But listen, a cheap price by itself isn't enough. We need confirmation. And that brings us to pillar 2, institutional conviction. This is all about seeing if the smart money, I'm talking about the biggest, most sophisticated financial institutions in the world, if they agree with our analysis.
We're looking for companies where these massive institutions own a really significant stake, often 70% or even more. I mean, when you see names like BlackRock and Vanguard holding a huge chunk of a company, it's not because they read a tweet. It's because they've done immense, very expensive, deep dive due diligence.
So why does this matter so much? Well, first, it's professional validation that the company is solid. Second, these institutions provide price stability. They have what's called sticky capital. They buy for the long haul and they don't panic sell, which helps create a floor under the stock price. And, maybe best of all, you get free corporate oversight. If management messes up, these giants have the power to step in and demand change.
Okay, pillar 3. This is where things get really exciting. It's all about high growth potential. We aren't just looking for cheap, boring, stagnant companies. We're on the hunt for a coiled spring, an excellent, growing business that is temporarily priced as if it has no growth ahead of it at all.
Now, the crucial point here is where we're looking. We're searching for this undervaluation in companies that are perfectly positioned to lead the industries of the future. We're talking sectors like AI, cloud computing, or specialized healthcare. The goal is to buy tomorrow's winners at yesterday's prices. And this combination creates an incredibly powerful double whammy effect. First, you get the return from the stock price simply correcting itself back to its true fair value. But then, as the company continues to grow its earnings year after year, the stock price is forced to follow that growth upward. It's a beautiful thing. So the formula is simple, but it is incredibly powerful. Combine a discounted price with a high growth engine.
The result is the potential for truly explosive returns. This is how you find those investments where the upside is just massive.
Now for the final piece. The piece that locks this whole strategy together and makes it so incredibly robust. This is the concept that protects you when you're wrong, and it supercharges your returns when you're right. We're talking about the ultimate safety net.
That safety net is called the margin of safety, and it might be the single most important principle for defensive investing. It just means buying a business for significantly less than its intrinsic value. That discount is your buffer. It's your protection against bad luck, unforeseen events, or even your own mistakes in judgment.
Let me give you a super simple analogy to make this crystal clear. Imagine you need to drive a truck over a bridge. You look at the engineering report, and it says the bridge has a maximum load capacity of 30,000 pounds.
Now, you wouldn't drive a 29,900-pound truck across it, would you? Of course not. That's insane. You'd drive your 10,000-pound truck across. That huge buffer, that 20,000-pound gap between the truck's weight and the bridge's capacity, that is your margin of safety. It means even if the calculations weren't perfect, you're still totally safe.
And this is exactly how that translates to investing. We want to buy a business that's worth $100, but we want to buy it for $70. That's our buffer. Most people, though, do the exact opposite. They're driven by FOMO, the fear of missing out, and they buy a $100 business for $120. They're not investing with a margin of safety, they are speculating with a margin of danger.
So, let's bring it all together. Here's your actionable checklist. Before you ever invest a dime, you just ask 3 simple questions. 1. Is the price significantly below its fair value? 2. Is it heavily owned and validated by the smart money? And 3. Is it a high-quality business with really strong growth potential?
When the answer to all 3 of those questions is a big yes, you've found a triple threat investment. You are fundamentally buying a dollar for 70 cents, and you're doing it right alongside some of the smartest, most well-resourced investors on the entire planet.
And what this framework really empowers you to do is to stop being a victim of the market's crazy whims and start becoming a master of your own financial destiny. Look, it takes patience, it takes discipline, but stacking the odds this heavily in your favor is always, always worth the effort.